Hi everyone, it's Alex King here at Cestrian Capital Research. I wanted to talk to you today about Microsoft's Q2 of their financial year ending June 2024. On your screen is our standard disclaimer. Just to be clear, nothing in this video constitutes investment advice of any kind. Okay, let's first of all look at Microsoft numbers. Let's go. So here on our screen we have our revenue down to EBITDA. Let me just talk you through it. You'll have seen this in the press, no doubt, but let's just walk through the key steps. So the big deal here in this quarter is that whatever you might hear commented on about different divisional performances or performance versus estimates, this company, which turned in $228 billion of revenue in the last 12 months, grew this quarter at 18.18%. So just sit back and think about that for a moment. So a $200+ billion revenue business is currently growing at 18%. That's pretty remarkable in and of itself. Now, in addition, growth accelerated. Now, if you look back to the end of 2022, this is the December 22 quarter right here, growth had slowed to a crawl, only 2% growth in that quarter. Now, every quarter since, in the last 4 quarters that are reported, growth has accelerated, got faster. 7% growth in the March 23 quarter, 8% in June, 13% in September, and 18% in December. That, again, is pretty remarkable. It tells you 2 things. One, Microsoft's in great health, and it also tells you that the US economy is in great health, because a poor US economy does not see that kind of increase in growth at one of its biggest companies. On a trailing 12-month basis, growth is now up to 12%. Again, terrific given the sheer size of the business. Gross margin took a small hit this quarter, but on a TTM basis, it's now at 70%, which is the highest it's been for a couple of years. EBITDA margins at a recent high of 56%. And then if we step through to summary cash flow, we like to use the unlevered pre-tax free cash flow measure, which again at a recent high of 40% on a TTM basis. So in this quarter, in short, the company grew very quickly for its size, much more quickly than the most recent 3 or 4 quarters. It turned in record recent high gross margins. It turned in recent high EBITDA margins and recent high cash flow margins. So all in all, that's a good quarter. Now, balance sheet, last quarter, the company had just shy of $84 billion of net cash on the balance sheet. That was impacted heavily by the completion of the Activision acquisition. We now have just over $22 billion of net cash on the balance sheet, which is clearly still a huge amount. And given that the company generates plenty of cash every single quarter, that's in no way of an issue that the cash has declined to that degree. One good thing and one slight concern, deferred revenue growth. Deferred revenue is pre-invoiced sales of revenue that has yet to be recognized. It's a forward-looking indicator of revenue growth. Ticked up to 16.16%, that's good. But the total order book, so-called remaining performance obligation, although it grew, and it now stands at $222 billion, which is an incredible number if you think about it, which is about equal to the last 12 months worth of revenue. The rate of growth of remaining performance obligation, the rate of growth of the order book is slowing a little bit. So if you look back to 2022, the order book was growing at 30+%. And as recently as March 23, it was growing at over 22% of the year. It's slowed markedly since then. So the June quarter, 18.7 growth, September 18, this quarter 15%. Now, that's still rapid growth for the size of business, but the thing to just keep an eye on is the fact that the order book is growing more slowly than recognized revenue. Now, if that doesn't change, there's a good chance that means that recognized revenue growth will slow. Not tomorrow, not next week, maybe not even next quarter. That's just something to watch. Valuation, to our eye, neither cheap nor expensive. So the stock is around $405 at the time of a recording, which is in pre-market hours on Wednesday, January the 31st. That translates to an enterprise value of just shy of $3 billion. That's around 13 times trailing revenue for that 12% growth on a TTM basis, around 23 times trailing EBITDA, and around 33 times cash flow. Now, is that expensive? Well, they're big multiples, but on the other hand, it's a huge, stable company that's growing at a decent clip with margins that are ticking up. So it's not going to be cheap. By way of comparison, if you were to go and buy Raytheon or Lockheed Martin or something like that on any given Tuesday, you'll pay around 20, 21, 22 times trading free cash flow. So if you think for a stable business generating a solid if unexciting dividend that's not likely to grow, not likely to collapse anytime soon, you'll pay around, let's call it 20 times trading cash flow. And for Microsoft, you're being asked to pay 33. Is that expensive? I don't think so. Is it a bargain? I don't think so. I think the valuation is okay. Let's look at the stock chart. Now, let me talk you through this. This looks complicated at first glance, but it isn't really. Now, what we've done is plotted on here two stock price outlooks. The base case, this is the dotted red line here, starts from the December 2018 low. At the end of December, the Federal Reserve at the time in 2018 had been tightening monetary policy, and then they reversed that under pressure from the administration at the time to go into loosening into 2019. We saw equity markets rise as a result, and so Microsoft struck a low at the end of 2018 around $93 a share, and in this base case outlook puts in a wave one high at January 2020 of around $193, $194 a share, corrects into the COVID low down to 131, not much of a correction you'll notice, and then put in a wave three high at the end of 2021, which came in at just shy of 350. A 61.8% Fibonacci retrace correction down into the 2022 wave four low in October, down to 214. And we're now in this base case outlook fairly extended in a final wave five. So the typical wave five termination zone is between the 61.8 and 78.6 Fibonacci extension of the wave 1 to 3 combined. That's obviously can vary, but that's a common place for these wave fives to terminate. An extended wave five, you might see terminate at the 100% extension. So if indeed this base case outlook is correct, if it's right to start this five-wave bull cycle at the December 2018 lows, then Microsoft's in an extended wave five already, and we might see the stock reach 430, 435, something like that before it rolls over and encounters significant selling pressure. So that's the base case outlook. Now, you can't evidence this yet, but there is a chance, a reasonable chance in our view, that actually Microsoft and markets at large, equity markets at large, ought to be charted from the COVID lows as a trade point zero, a kind of year zero. And you can construct ex post facto reasons why that might be, but just on pure chart logic, this is working at the moment in the S&P, the NASDAQ, in Apple, Microsoft, stock after stock. And so if that's correct, we end up with a much more bullish outlook. So let's say we started that COVID low of 130. We're in a bull case. Bull wave one peaks at the end of 2021 at that 350. Bull wave two, again, a 61.8 correction. So that's a righteous wave two. And then if this bullish outlook is correct, we're likely in a wave three up. We're probably only about halfway up. And so it's possible that Microsoft on this look could reach something like $570 a share. Now, it's not possible, in my opinion, to conclude yet whether we're in the final stages of a bull market or there's plenty further to go. But if Microsoft stock exceeds around 435 and it keeps going, then I think there's a very good argument that actually we're in a sustained bull market, this wave three type bull market, and Microsoft can go much further. For now, we rate Microsoft at hold. I own the stock personally, and I'm not adding, I'm not selling, just holding the stock and just waiting to see what happens. So in short, great quarter, valuation, not expensive, not cheap in my opinion, and the stock, even in a cautious outlook, probably has a little further to go, and I think there's every chance it could go a fair bit further. Thanks for listening to our work as always. Don't forget to follow us on YouTube. You can do so. You can follow us and subscribe in the links on this page, and look out for the rest of our work at cestriancapitalresearch.com. Thanks, folks. Talk to you soon.